Scott, good to see you. And yeah, we've been bearish since January, early in January when the S&P was at 4,700. So the reason why our conviction is so high right now is for a few different reasons. Number one is we need to listen to what the Fed is telling us. I thought Friday's speech was exactly what it needed to do, and I think it was very important. The person that holds the keys to the castle is telling us that growth will be below trend for a sustained period. Households will feel pain. Businesses will feel pain, and that this is going to be an unemployment rate is going to rise. That environment is not good at all, without stating the obvious, for equities. So then the question is, okay, is it priced in already? And not only is it not priced in, but valuations are actually well above trend because of the move in interest rates. We have a Fed funds rate that's going to go very shortly to a 15-year high. The 2-year yield is a 15-year high, and yet if you look at the multiple's trading at 17 times earnings. The 20-year average is 15. We hit 14 in 2018. So valuations are on the higher side. And the final point I would make is that from an estimate perspective, you might say, oh, have earnings bottomed, and is what he is saying already priced into estimates? Mm-hmm. It's the exact opposite. Our earnings are at well above trend and are towards the end of the cycle. And even whether you think that there's a lot of downside to earnings, which I do, even if you don't think that, there's certainly no upside. I think we can all agree with that. And so the dynamics in the market are just not friendly right now. And finally, the sentiment and positioning is no longer a headwind for our view. And that's really important.
Okay. So the pushback on your view, I frankly find difficult. I mean, it's conventional wisdom. Fed tightens, don't fight the Fed. The Fed has told you explicitly what it's going to do. And for the non-believers, Powell whacked you upside the head on Friday just to make sure you were getting the message. Kashkari, as I read earlier in the show today, underscores that. I'm not sure if you heard his comment or not. But he basically said he was happy to see what happened after the Powell remarks because it gets everybody awakened to the view that they are going to be resolute in getting all of this taken care of. So I hear you, but I want you to hear Tom Lee, because there is pushback, not from many, but from some, including him. Listen.
There's, I think, a misconception that just because the Fed is raising rates, markets have to fall. It really depends on how much is priced into market expectations already. If you look at the rates markets, it's already priced in the Fed being pretty aggressive into year end and actually even staying pretty tight throughout 2023.
That speaks to your point of what you're trying to say, but how do you respond to Tom Lee? He's no dummy, and he's not the only one with that view.
Sure. So I think from the rates market perspective, I think it's mostly priced in, but it's not priced into the equity markets. And I think the point that you were also making, in the beginning of that comment isn't this known? Well, I think if you look at positioning and you look at the individual's allocation to equities, the individual is still close to historic highs. Okay, so the individual investor has not sold at all, and we know over the last 2 years they've added somewhere between $1.5 and $2 trillion to equities. They still have not sold at all. Institutions, their positioning has come down, but I think that's where a lot of the supply can come going forward. And I would just ask, a 17, when you think about where we were post the pandemic, we traded at 22 times earnings. That's when the Fed funds rate was 0. We were buying $4 trillion of assets. The 10-year was 50 basis points, and we were on trough earnings. Now we're at 17 times. And so where is the upside to that when the 10-year has gone up, sixfold, the 2-year is up, tenfold, and we're starting quantitative tightening, and we're towards peak earnings. So I just don't see, from a risk-reward perspective, the reward is incredibly limited. And the risk, if I can just walk through some numbers, because I think we're going to the low 3,000s, as I've told you. If we trade at 15 times earnings, which is the average multiple from the last 20 years, and you assume that next year's earnings go down by 5%, which, based on what Powell is saying on Friday, doesn't seem, and where earnings are, doesn't seem that heroic. That's 3,200 on the S&P. So we have numbers to back up why we think that can happen.
I'm sure you do.
Yeah,
I'm sure you do.